Well, at the short term, you're going to see quite a lot of volatility associated with the bond yields, especially on the long end. And therefore, that's going to create some market volatility. But if you stretch it further out towards the end of this year or even into next year, what's clear from the Federal Reserve is that they are going to keep the short end very well anchored. They've communicated that sort of policy at their recent meeting. And therefore, I think from that perspective, with inflation also starting to become more controlled going out into the second half of this year, you can actually expect long-term bond yields to perhaps stabilize in third quarter or fourth quarter. I think that's going to be very likely the scenario.
It's interesting you mentioned that because the Fed, it seems, is happy to let inflation overshoot on the upside. What exactly is the Fed's tolerance when it comes to a threshold that they're looking at?
Well, for the Federal Reserve, they are looking at PCE inflation at 2%, and they are willing to let inflation overrun or overheat for some time. And it's clear from where they communicated in terms of their average inflation targeting regime that they can actually let it run for even a few months or even in a year or two before they get even a concern. And I think from that perspective, you have seen how they communicated it through the dot plot, in which many of their members within the FOMC are more concerned about getting the economy to recover right now rather than hiking rates. So you can expect zero interest rates for this year, next year, and even further out. And I think from that perspective, with the short end extremely well anchored, the volatility associated with the long end of the yield curve is probably something that we might see in the next few weeks or perhaps in the next month or two, but it should stabilize going into the second half of this year.
Okay, so James, in light of what we just talked about, how are you positioning your portfolio? Where are you invested?
Well, at this stage, what we do is that we are actually underweight safe haven bonds, but where we want is to continue to search for yield, especially in the US high yield space, or even globally in Asian credit, where we can get more income for our investors. And of course, in terms of equities, we continue to prefer equities over bonds. And within equities, we like the US and Chinese market, as well as sectors such as financials, technology, and the cyclical sectors such as materials that we think would do well in this whole broadening of economic recovery.
But is there an argument that some of the sectors like financials, like energy, that have done very, very well in this reflation phase over the past few months, that they maybe are needing of a breather or even bigger breather when it comes to energy?
Well, at this stage, what we are witnessing is a sort of consolidation and a heightened volatility associated with these sectors. Because if you take to the perspective, many of these sectors have run up significantly. And I think it's a right time in which there is some volatility associated with this sector. But we think that the longer term prospect of the economic recovery remain very much entrenched. And therefore, this whole pullback is actually an opportunity for investors who have not yet had positions in these sectors to actually gain exposure. And I think this is an opportunity for those investors to buy on that dip.